Welcome to the Capital News. I'm your host, Alex Corritis. Today is Thursday, May 14th, 2020. Thank you so much for joining me. Title of today's podcast is The Fed BS. And of course, we know what BS stands for. Balance sheet. So I thought it was fitting because obviously we know what those initials also stand for. And it's just a little bit of a follow-up to yesterday's podcast. Negative rates are coming because there was one note that I did forget to mention during yesterday's discussion, so I want to make sure that we talk about that again today because it is very reminiscent of what former chairman of the Federal Reserve, Ben Bernanke, informed us over a decade ago. So it's very important, I think, to highlight such rhetoric once again, and we'll get to that. Market performance, what a topsy-turvy day today. Of course, it is Thursday, so that is an update to the Federal Reserve's balance sheet, and that is also an update to the initial jobless claims for the prior week. Typically on these types of days, over the past several weeks, we have seen the stock market here in the United States, all of the indexes, rally. I mean, the news couldn't be bad enough. The worse the news, the worse the numbers, the bigger, the stronger the rally. Well, today, this morning, you would have thought, well, my goodness, maybe there is some semblance of sanity in the financial markets, in the stock market, in conjunction with a deteriorating economy, which is evidenced in the initial jobless claims. Once again, for last week, which is about 3 million, another 3 million Americans filing for unemployment insurance. But the market, even though it was down this morning, around noon, it became that little engine that could, and it started to take off. And being down a few hundred points on the Dow Jones Industrial Average, ended up being up a few hundred points, over 1%, close to 2% actually, by the end of the day. So quite a reversal. It's a very strong move. And of course, once again, on the back of a poor initial jobless claim. And those numbers came in just shy of 3 million, 2.981 million. 2.981 million. Of course, this is down from last week's number, which was right at 3.176. And of course, this is the continuation of a downward trend, which obviously makes sense because we saw those disastrous numbers in April, even in March, of almost 7 million Americans filing for unemployment insurance for 1 week alone. So in aggregate, we're about 36 million Americans over the past several weeks filing for unemployment insurance. Now, when it comes to the continued claims report, we are now updated for May 2nd. So still a little bit of a lag on this, but May 2nd, and we're now sitting, again, this is continued claims, at 22.8 million. 22.8 million. Slightly above last week, or a couple weeks ago, on April 25th, which was at 22.37 million. But again, we were at 22.8, so a slight increase. But I do believe this number was less than what the market was anticipating, and I think the market was anticipating a number closer to 25 million. So continued claims, again, there's going to be some screwy numbers going around here. We've had these discussions many times before with all of the stimulus measures that are coming through from the Federal Reserve, from the federal government, with the Payment Protection Program, all the Small Business Administration loans. Again, one of those contingencies to getting a loan is you have to bring your employees back. Now, it doesn't mean that they're working, but if you want the loan to be forgiven, you have to put your employees back on payroll, and of course, that's assuming you laid them off to begin with. So there could be people that are coming back into the labor force, actually back with their job, but it doesn't necessarily mean that they are working. So there could be quite a few actually head-scratching numbers in the future, depending on how all of this unfolds, obviously, and we're in no man's land, so it's going to be anybody's guess. But you could have some people wondering, well, my goodness, continued claims are continuing to go down. That must mean people are going back to work. Well, they're going back to being on payroll. Whether they're working or not remains to be unknown. So we're going to think, well, all these people are going back to work. GDP is really going to take off. We are going to get some V-shaped recovery, and then that might not happen because they weren't working. There was no production. So no production, not really anything to sell. What's going to happen with GDP? Again, we're obviously anticipating just a record-breaking number for the second quarter, and then we'll obviously have to see how everything transpires over the coming weeks to see if there is going to be a full-fledged, full-blown reopening of the U.S. economy from coast to coast, if it's going to be piecemeal. Is there going to be a second wave? Are schools going to reopen for the remaining, month that's left in the school year? Will school sports come back in the summer, fall ball, any of that? A whole bunch of unknowns obviously remain out there. But we know what's taking place with the numbers. The unemployment figures came last Friday. We read that report in its entirety because it was an historic report. And we know that these numbers are skewed. We know that the Bureau of Labor Statistics that produces the jobs number even stated in their report that they're probably understating it by 5%, meaning the unemployment rate, the headline rate, should be not 14.7%, but something closer to 19 or 20%. Okay, and that's the headline figure. And then, of course, when you look at the broader measure at U6, it was 22.8%, if memory serves me well. So there's a lot still to get through on this. Now, when it comes to the Federal Reserve's balance sheet, we are at $6.9 trillion. $6.9 trillion on the Federal Reserve's balance sheet. This is up from last week, which was sitting at $6.7 trillion. So, past couple of weeks, it was, increasing by 50 billion here, 60 billion, 80 billion. Now we're back to 200 billion in the course of a week. We told you it wouldn't take long for them to jack it up again, and here they are, getting very, very close to that $7 trillion number, 6.934 trillion. Unbelievable. Unbelievable. And they want to tell us that negative rates are not coming? Come on. They're already here. Just admit it. Let's get this over with. Because the other thing that I forgot to mention yesterday that Chairman Jerome Powell mentioned during his interview was he claims that once this crisis is over, all of these tools that they're using in their toolkit, they're just gonna put them away. They're gonna be done with them. They're gonna put them back in their drawer again to collect dust. Does anybody really believe this? This is what, again, Ben Bernanke told us a decade ago, that this is just temporary. It's just to get us out of the depths of the great financial crisis. And surely as soon as it's successful, we're going to draw it back. We're going to pull it back. We didn't start attempting to normalize, ladies and gentlemen, until 2017, 2018. Almost a decade after the start of quantitative easing. And again, you had QE1, QE2, Operation Twist, and QE3. So it's not like it was just one. There was multiple. Couldn't normalize. And again, that took us on a Federal Reserve's balance sheet, the entire history of the Federal Reserve from 1913 to the Great Financial Crisis, $900 billion balance sheet. Through the course of quantitative easing, they got it up to $4.6 trillion. They said, okay, the economy's finally starting to hum along, Now it's time to normalize. Well, they tried that. Interest rates got up to 2.25%, 2.5%. Federal Reserve's balance sheet got down to, a little bit below 4, 3.6, 3.7 trillion. Wall Street had a conniption fit. Donald Trump had a hissy fit. That was it. Can't do it. Not on autopilot anymore. We're not going to do it. We're not going to continue increasing interest rates. It was a booming economy, the best ever, ladies and gentlemen. We couldn't tolerate 2.25%, 2.5% interest rates. Newsflash, that means it wasn't strong. And of course, those of you who have been following the Capital News are well versed in this. You understand this because we look under the hood. We don't just look at the headlines. We look at the real data. We draw the right conclusions. Because we don't have a dog in this hunt other than the truth and getting it right. Are we right 100% of the time? No, of course not. Nobody is. But we never made the comment that this was the greatest economy ever in the history of the country, because it wasn't, it isn't, and it's not going to be anytime soon, especially with the actions that have been undertaken by the Federal Reserve and the federal government, which once again are reminiscent of what was done in the depths of the Great Depression, which actually turned it into the Great Depression. The government has to step away. But of course, that's not politically convenient. It's always more politically convenient and politically profitable to kick the can down the road, to increase your deficit spending, because we're broke, so it's all deficit spending, and to have your Federal Reserve the sanctioned counterfeiter, turn the printing press on to get as much liquidity out there as humanly possible, which we are witnessing. Federal Reserve's balance sheet, and we could look into the money stock, M2, and all that stuff too, and that's just as atrocious. It is out of control, and we are all going to be paying the price for it. And this, again, is just to keep the system afloat. Afloat. We used, again, that example of $3 trillion, which we will be borrowing for the second quarter alone of this year. You divide that by the 33.5 million, and of course now it's 36, but you divide it by the 33.5 million Americans who are unemployed or filed for unemployment insurance over the past several weeks. It comes to $89,000 a job, roughly. Most of these jobs make well below that. So this makes 0 sense whatsoever looking at it in that context. And you can look at it and slice it and dice it any way you want to, and it's not going to make any sense. None at all. And of course, we have the Democratic plan coming out for another $3 trillion, which, again, we don't have. To bail out the states to the tune of $1 trillion because they're broke. Giving people $2,000 a month. I mean, why not, right? Why not? I guess we're embracing MMT, modern monetary theory. Universal basic income. No outcry, really, from anybody. There's a little bit of defiance now. Now that we have a national debt that's north of $25 trillion and soon to be by the end of this fiscal year, probably in the realm 26, 27 trillion. We'll probably be around 30 trillion next year. Don't doubt it. A national deficit this year alone by the end of September, because that's the fiscal year. And 4 trillion, 5, 6, all depends on how much more spending they do, because the whole purpose of the stimulus spending is to get it out there as quickly as possible. And of course, we use stimulus lightly, quote unquote stimulus, because it's not stimulative in any sense of the word. This is just filling a huge void, a hole that's getting deeper and wider, and that's what's taking place here. It's a bunch of BS from everybody. But just like they told us, again, the Federal Reserve, that once the crisis passes, we're going to put all these tools away. We're going to normalize. No, it didn't happen. It did not happen last time during the great financial crisis. And if you're going to say that this time is even worse, which it is and it's going to be, then there's no way they're ever going to put these quote-unquote tools back in their toolbox. They're not. That's why negative rates are coming. It might not be attractive now. Well, keep drinking. It'll look a lot more attractive in the near future. And that's what's going to happen. They might play good cop, bad cop. The market wants negative rates. The president wants negative rates. The Federal Reserve wants to look independent. It's the same ball game that happened in 2018. Same exact thing. Who caved? The Federal Reserve did. Are they really independent? No, they're not. Who are they working for? It's not the American people en masse. En masse. It's for those who hold financial assets. It's for the major corporations. This is not some conspiracy theory. Look at where the money goes. One of the rules of the cynics in our book, The Cynic's Guide to Investing. Who benefits and follow the money. These are century-old adages. This isn't rocket science. I didn't make this stuff up. Who benefits, cui bono, and follow the money. That's all you got to do. Where are the trillions going? Not into your bank account, but corporate America's getting it. Corporate America's getting it. Very little strings attached, if any. No problem. Small businesses, mid-sized businesses struggling to get anything. But if you're an airliner, if you're in the energy sector, if you know these Republicans and Democrats and the President of the United States, you're in like Flint. You don't got to worry about a damn thing. But if you're an individual, small business, mid-sized business, you better watch out. It's not good, folks. It's not good at all. So we do not trust the Federal Reserve. Same song and dance, same playbook, hoping for, I don't know what, a miracle, I guess, that somehow all of this money printing, all of this deficit spending is somehow going to lead us out of it. In fact, it's going to lead us deeper and deeper into the hole. Where is all the growth going to come from to pay off this debt, to pay off these deficits? And I mean, people say, well, nothing's ever happened. Well, it is happening now. Because you could read books from Milton Friedman, and he's a monetarist when it comes to economics, the Chicago School of Economics. You can read a lot of the Austrian economists out there, Murray Rothbard, von Mises, Hayek. I mean, these books go back, okay? 70s, 60s, 1980s, all that stuff. You'll read them as if it was today. They've been warning about this stuff for years. The day of reckoning was going to come. Now, of course, they thought it was going to take place during their time, just like I think it's going to take place during mine. So it's possible that they'll continue to kick this can down the road. The question is, how sustainable is it? And is this really the system that we want to operate? Is this really the system that we want to salute and support and go to work for, so we can pay 30% of our labor, of our income, to a government that props up this system? Does that make any sense? To me, it does not. Not for a second, which we noted in our book, The Cynic's Guide to Investing, very early on. So the reader was in tune with us, the authors, because I'm a co-author to the book. What type of system do we have? Yes, the government, the Federal Reserve, saved the system. But what system? Not free market capitalism, clearly, by definition. It did not save that because free market capitalism is not here. This was a form of fascism with a big side dish of socialism, which we're still living in. And you could just call this all corporatism if you want. I mean, that's what Mussolini said was the better term, because it's the merger of big corporations with the government. And that's exactly what we have. It's exactly what we have. The stock market is basically comprised of 5 stocks. 5 of them. All of them are pretty much joined at the hip with the government, and all you have to do for that information, again, not a conspiracy theory, is go look at Edward Snowden's whistleblower documents that were released years ago. The same companies with the back door for the government. Oh yeah, come on in. Come right on. Get all of our information. Big Brother has been here, ladies and gentlemen. We can ridicule the Chinese Communist Party, the CCP, and say, that's totalitarianism, that's Big Brother. And we say that because it's all from the government, right? Here in the United States, well, yeah, the government does some stuff, but, all these other companies, they're companies. It's not the government. It's really the same difference at the end of the day. Because it's information collected, monitored of you, where you're at, what you're doing, where you spend your time looking at, all the stuff you're searching for, the stuff you're reading, what videos you like, what books you want to read, who you're talking to, who you're texting to, all that stuff. It's all being recorded and monitored. We know this. And of course, those major companies came out with their PR schemes. Oh no, there's no backdoor, we don't do this, and it's right back to it. There was no major investigation. There was nothing. It was demonize the whistleblower. And we can have that discussion, but we know what information came out. So it's always the pot calling the kettle black here in this country, and I'm just fed up with it, because the hits just keep on coming. It's always distract. It's always divide and conquer, and we're going to see that on steroids coming soon. The blame game is definitely going to amp up. We are in a presidential election. If this economy opens up and these candidates can get back on the road and start campaigning and get to their rallies, I mean, it's going to get nasty. It's going to get nasty even if that doesn't happen. And now everybody's going to go back into their respective silos. The Republicans are going in there. Democrats are going in there. And that's it. That's it. Be hunkered down for the next 6 months. Until the first week of November. That second Tuesday. Unbelievable. But that's what we're going to have. Now, some of the market performance right now. We have the futures markets trading, obviously. We have the Dow Jones relatively flat, but in the red slightly. S&P 500, same thing, basically flat, but up a little bit. NASDAQ 100 is up about, let's call it 0.3%. The Japanese markets, the cash trade is trading at 104 points in the green, representing an increase of 0.5%. Across the pond in Europe, all down in the negative, anywhere from 1.3% to 2.75%, depending on the index. Not a good day for Europe. Australian cash trade right now is trading in the green, up 0.9%. On the commodity front, big day with oil, big day in oil. WTI is trading at $27.83 a barrel. Brent, the international metric, at $31.64 a barrel. Natural gas, $1.69 per million British thermal units. Nice day for gold and silver both. Gold is trading at $1,732 an ounce. Silver, $16.08 per ounce. So we got a 16 handle on silver. And I do have to say, obviously, I've been telling this audience for months that I believe that the precious metals markets, particularly gold and silver, are in a bull market. And they will most likely continue to be for some time because of these antics that are being undertaken by central banks and federal governments the world over. And that's just the economic policy. Then you have to take into consideration all of the political turmoil that's likely to ensue, perhaps a disintegration of the European Union of some sort, the recurrence or the resurgence of the protests, the global protests, many of which were taking place prior to COVID-19. Now, once they open up and it's even worse economically speaking and perhaps politically, depending on how the country handled the crisis or is handling the crisis, you're likely to see even more. Okay, and I do imagine it will be coming to a theater near you. We've already started to see some of these protests in the United States. Thank God they've been peaceful with all of these, anti-stay-at-home orders, which is understandable to some degree. So they're coming. That's something that is bullish, in my opinion, when it comes to precious metals. Then, of course, those are the political risks. And then you have, also with the geopolitical risks, you could throw that in there. But when I say geopolitical risk, I mean the war. And it doesn't have to be a hot war, although it's likely that we're going to see civil wars or some type of government overthrow. There could be proxy wars. We talk about Iran and Venezuela here quite a bit. Those could take place. It could be further economic wars, particularly between China and the United States. Again, that blame game is going to heat up. Could be anything. And when you have all of those unknowns, that should do well for gold and silver. I do not give investment advice here. I give information, tell you what I do, what I would do. You look into it, see if it makes sense for you. But I can tell you from a technical standpoint, from looking at the chart, especially with gold, it's a pretty solid chart. It is a pretty solid chart, formed a nice base. We had that pullback several weeks ago. It recaptured all of that loss relatively quickly. It's been in a period of consolidation, and it looks like it's ready to break out. And we always said, historically speaking anyways, that gold will lead when it comes to the difference between gold and silver, because gold is real money. Always has been, always will be. Fiat currencies come and go. The funny money comes and goes. Gold is the real money. It's still a reserve. It's still a reserve for governments and central banks the world over. If it meant nothing, then why do they hold it? Right? Very interesting question, isn't it? So, looking at gold in the context of today's trading session, because it whipsawed, right? Gold stocks were much in the green today. They had a strong performance today. When the market was down, gold stocks were doing very well. When the market recovered and rallied through the end of the day, gold stocks hung in there. To me, that is a positive sign. Does it mean we can't go down? Of course not. We can always go down. We can always reverse. The market is known for pulling the rug from beneath us all the time, happens all the time. But I do think over the long term, especially given the political, geopolitical risks, the economic risks, all of these uncertainties, this is a safe place to be. It doesn't mean that you put 100% of everything there, but you look at it. You say, well, yeah, that might be a good hedge. There might be some good protection. Might maintain at least some purchasing power if we do get some sort of inflation. And of course, that's a process. But you'd rather be early to the party than late, especially if you can stomach the volatility. And then silver, historically speaking, does tend to catch up to gold. And then from a performance standpoint, it outperforms. And it typically outperforms pretty strongly. So look into it. Do yourself a favor. And then lastly, on the political front, I'm not going to go into great detail with it, but I would suggest you do and take the time to look at it because I think it's interesting, especially we're in quarantine. There's nothing to do, and especially those of you who like, to see the government functioning at some point. The Supreme Court heard a couple cases the other day in regards to the president, Donald Trump, versus district attorney in New York from the state, and then also Congress, who are have subpoenaed some of his documents when it comes to tax returns and other banking and other financial documents. Now, of course, like I said, this made it all the way to the Supreme Court. The lower courts have held for both cases, because these are two cases. Again, one is from a state perspective from the district attorney's office in New York, and the other is from federal court because that related to Congress, because there were a few committees within the House that were requesting these documents. Now, again, the lower courts ruled in favor of the district attorney and in Congress. So that's why the president and his legal team fought this, appealed it, and it made its way to the Supreme Court. Now, for a case to be heard at the Supreme Court, 4 justices have to agree to hear it. If you don't get 4 justices who want to hear a case, they don't hear it. So this was heard this week. You can check out the oral argument. You can go to supremecourt.gov, check it out, oral argument. You'll get your list. You'll see Trump versus Mazars, and that was his accounting firm. And you have Trump v. Vance. That's the one with the district attorney's office. Take the time to listen to them. They're both about an hour and a half long. If you're looking for something to listen to, if you just want to turn the TV off, get away from the news and all that jazz, and you just want to say, okay, let's see what's going on in the Supreme Court. I mean, we're paying for it. That's where your tax dollars are going, so you might as well use it and see what's going on, because if the Supreme Court upholds the lower court's judgment, well, then it's just going to be a matter of time before these documents make their way into the public domain, being the president's tax documents, some banking and other financial documents for himself, his family, his corporation, and other businesses. So it will get very, very interesting. I'm going to reserve my judgment on it. I do have a take on it after listening to both cases and hearing the justices ask their questions and hearing both sides argue their points in favor or against accordingly. Very interesting. Very, very interesting. Take the time to check those out, because this is a rare event. There's really only a couple other cases that were at least cited in the oral argument. Of course, the real meat and potatoes of any type of judgment rests within counsel's written argument. But they're really citing a couple things with Clinton when he was sued by Paula Jones, and when Nixon obviously had a lot of his issues at the end of his presidency. And then, it comes to the question of undue burden. Are we opening the floodgates for anybody to come after the president? Interesting questions. And here's the best thing about it. You can have your own opinion. You do not need to be a lawyer or a justice on the Supreme Court to come up with an opinion. You know why? Because they're not always in agreement. Okay, we don't have a lot of cases where it's 9-0 or 8-1. There's a lot of 6-3, 5-4 judgments. The Constitution isn't written in ancient Greek or Chinese. You can't interpret it yourself if you read it. If you listen to these arguments, you sit down, you think, does this make sense? What should happen? Is this an overreach of power? Will this really open the floodgates? Who has standing? All of these interesting questions, at least they are to me. So again, check it out, supremecourt.gov, oral arguments, Trump v. Mazars, M-A-Z-A-R-S, and Trump v. Vance, V-A-N-C-E. So that's it for today, ladies and gentlemen. The Fed BS, do not trust them. Do not trust them. And if it's bad news, the markets are going to rally. They did not disappoint. I was shocked this morning when I saw the markets in the red. I was like, whoa, what happened here? What happened? I said, what, initial jobless claims 3 million. That's not good. It was worse than markets were anticipating. Why are the markets in the red? That makes too much sense. And then, of course, lunchtime came around and things were back to normal, which means insanity. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.